You're actually in one of the most exciting spaces in the markets right now. Like, how do you see debt capital markets developing? The market is unsure about what the Fed does, and they're pricing in cuts. Do you worry about something ugly happening?
Well, first, good morning, and thank you for having me. I think as a credit person, I always worry. Is
that part of the job description?
That's part of the job description. But I think you have concerns around here. We've had a robust rally here in the past 5 to 6 weeks. It's been a significant within the high yield market. You've seen a 75 basis points of tightening on a spread basis. You've also seen Treasury rates come down. I think probably some of the concern is, are we truly out of the woods? Right. You still got geopolitical concerns. We've still got inflation hanging in the balance while it looks better. The consumer continues to spend, but can they sustain that? Yeah. Employment picture remains strong, but can that be sustained? There's a lot still to work itself through the economy, and there's always the unknown unknowns that we don't know, and you worry about whether that's another regional bank crisis or something like that. So while we're optimistic and we feel good about going into next year, and we've been positively surprised by the resiliency of the economy, we still have room for caution.
So this is what I find incredible, that actually despite, and I speak to chief executives on a daily basis and say, look, the economy, the figures, the data points are all very positive. But mathematically, I just don't see how that's possible longer term if you go from, like, let's say 1% interest rates to 5%. Yep. Is that fair?
No, it's fair. And I think what I think you have to look at it from a standpoint of higher interest rates are still working its way through the system. Right. We have been in an environment where there's been on the greatest refinancing wave in history. A lot of maturities were pushed out. That's part of the technical picture that's helping the debt markets right now, because you've got limited issuance, still a lot of cash out there in the system. But we will see issuance needs pick up over time, and that's going to come at higher rates. Now, we think corporate balance sheets are healthy and are set up to absorb some of that. But it's still going to have to take a fair amount of navigating.
We did 2 charts for you, the Foley charts. I mean, they're wonderful because one looks at investment grade and the other one's high yield. I mean, where do you see actually, if you look at high yield, do you see opportunities?
Well, I think you first take it from a standpoint of an issuer perspective. You are right now on a spread basis, 500 basis points inside the recessionary average for that index. You're still 75 basis points inside the average for non-recessionary. So while rates have gone up and overall yields and cost of capital have gone up, on a spread basis, it's still really attractive. So you have to keep that in mind.
Is that right, though? Is it right the way it's behaving? Or is there something that you think is odd in the way that...
This is what we knew earlier in my career, right? This is the new normal. This is normalization. It's not, you look at, there's a lot of debate, what's normal, what's abnormal. A lot would say over the past 10 years, having ultra-low interest rates was more abnormal period, and we're getting back to normalization, which is interest rates where they are and spreads where they are.
Okay, I guess the question is, when you speak to central bankers, they're trying to get through the message to markets that it's higher for longer, and markets just are pricing in cuts and more cuts. What does that mean, again, for your world and your space and how the debt capital markets will behave?
I think that's where, to your earlier question of where there's a potential for volatility. Right. The market is pricing in rate cuts, in particular in the back half of next year. That's assuming the market, the central bankers have the luxury of doing that, of inflation under control. It also, you have to look at the flip side of that and say, well, if they're cutting rates, that might mean a weaker economic environment. So does that mean spreads in our markets gap out? And it goes back to those recessionary average. So what we're having the debate with issuers of, here do you wait? So, yeah, rates may come down, but you might see spreads gap out because we're in a weaker economic picture. So how do you've got to factor it all in.
So, Kevin, when you look at outlook for 2024, when you look at investment grade markets or even leveraged finance, what do you find most interesting? Where do you think, without using the word sparks will fly, certainly what we should be watching out for?
Well, I think first, from an issuance standpoint, we expect investment grade is going to be flattish year over year. High yield market, we expect up around 40% year over year. The leveraged loan market up about 20% from a pure issuance standpoint. It is what we've been talking about. Whether inflation remains under control, the economy remains resilient, what's that going to give the central banks flexibility to do what they need to do? Geopolitical concerns are still out there. So there's a lot of things hanging in the balance. It's more of the same in terms of the issues that we're discussing. And then I think, like I always like to note, is the known unknowns that there's always a chance for surprises out there.